It's been a while since we've had a chat, but I just thought it might be a good opportunity to maybe pick up on one or two of the points that the guys have been raising in the membership on the forum. And one of the questions that popped up recently was, why are we using such long-term lookbacks on the Donchian channel? Donchian, depends how you say it, but it's all the same thing. And I thought it might be instructive just to look back a little bit to see where this channel's come from and why people are using it the way they are. And so I did a bit of just a Google search on Richard Donchian, and lo and behold, he's known as the father of trend following, which coincidentally is what we're doing. So that probably gives you a bit of an insight as to why we chose this indicator as one of our first ports of call. And so the question then is, what is this channel? How is it generated? And what are we finding with it? And the question that was specifically asked is, why are we using such long lookbacks when the standard Donchian channel uses a 20-period lookback? And so I thought that'd be a bit of fun to pull apart and see where we go. What do you think about that?
Mate, that sounds good. Let's go for it.
So what is it to start with? Well, basically what we're looking, or what the channel looks to do, is to look back in time. And typically it's on a bar chart or a candle chart. And the idea being that it looks back to whatever period you've set to see what the highest high was and the lowest low was within that look back period. So if you've got a 20-period look back, the last 20 bars, what's the highest high? That marks the top of the channel. What was the lowest low in that period? That marks the bottom of the channel. So effectively having a look back of 20 periods means you're looking at breakouts. If you're looking to break it into or above that channel, you're looking for a breakout over the last 20 periods, either long or short. And so the question again, why are we looking at longer than 20 periods? Well, 20 periods may be sufficient for some of your strategies, but when we put our parameter set into our look back settings, we don't want to limit to the standard settings. So we've opened that up and we've said, well, we're really looking for long-term breakouts. So by using a minimum of, say, 50 periods, that gives us about 2.5 months in terms of a daily bar. And we're looking for breakouts of some significance. So let's look, and I think, correct me if I'm wrong, Rich, but didn't we say our maximum on some of our EAs, we've actually looked out to 1,000 bars, which...
Yes, mate, yep.
Effectively a 5-year look back. So we're looking for some significant breakouts. And
I think, yeah, one of the things is when they refer to the traditional setting being 20, I think certainly back in the 1980s when the Donchian was heavily used as a breakout technique, and for instance it's integrated within that the Turtles trend following system, which was very popular under Richard Dennis with the Turtles experiment, where the Donchian was one of the central components of that breakout technique. And back in the 80s and 90s, they had incredible success using a fairly short look back. But I think the question has always arisen, well, does the Turtles strategy still work today? And I would maintain, yes, it does, but the particular settings used for those variables need to be adjusted. And I think what probably has happened is that we've found that the participant mix in the market has changed over the last few decades, particularly with the algos and central bank intervention and all of these things, which has therefore changed the nature of the breakout, where I think there is when you look at the comments made by the medium to long-term trend following funds, they've all mentioned how in the last few decades they've been forced to step out to longer-term lookbacks. And I think that might be attributed to the increased prevalence of noise in the market and increased prevalence of mean reversion in the market, which means that the conventional setting of the 20 look back is now no longer appropriate. It still does catch trends, but there's an accompanying loss associated with whipsaws in those sort of tighter look back zones, and you need to sort of step outside those zones to experience more the sort of fat-tailed environment as opposed to the normal trading environment, if you know what I mean.
Yeah, so I've noticed that as well. When you have the shorter periods, you get these breakouts. You think you're onto something, but effectively what happens is it fails, as you say. We get into a whipsaw scenario. So to get a decent long-term trend, you really need to look further out. The other interesting thing is that in share trading, for example, a lot of the common strategies tend to look at a 52-week breakout. What happened in the last, what's the highest high of the last year?
Yeah.
So effectively, that's a 200-period Donchian, isn't it? So even there, we're looking at some significant.
Yeah, I agree. Look, there's always a temptation to make a generalised statement, but what you and I have recognised is that we've got to be careful when we talk about these type of ideas when we relate them to generic principles. So commodities, for instance, clearly operate in a different way to Forex as opposed to equities, and the bias in those particular asset groupings is different, which therefore means you need to accommodate different methods effectively in those different asset classes to catch what we'd term trending conditions. And so I think what our members would be interested in is we have found that there's no one size fits all for these asset class groupings, but there are when we come down to an actual grouping such as commodities, or a grouping such as Forex, or a grouping such as equities, within those subsectoral groupings, there are sort of common sweet spots. So, when we apply our optimization with our Donchian look back, our intent is not to say, well, we're only going to look at medium to term look backs. We let the optimization result demonstrate what is the most effective choice of variables over a very long-term data set, and they naturally start plotting in this sort of medium to long-term range, and we actually don't get many solutions plotting in that short-term look-back range, which is saying that the data is suggesting that the sort of optimal zone, there is an optimal zone outside of which, or there's a congested zone outside of which trending conditions seem to predominate, but within what we refer to as more the noisy, normal, everyday environment, there clearly is much more activity in relation to mean reversion and the sort of the impacts of all of the different participants in the normal churn of the market is such a sort of a frenzy that clear trends are pretty hard to come by. And you might catch a couple that you think are real trends, but as we've found that they're more likely to be just trends that are comprised of noise, not serially correlated.
Yeah, the other point about that, and coming back to the original question, is why are we using such long look back periods? Well, the reality is we're not dictating what look back period to use. We're letting the data tell us. So by scanning the market from 50 through to 1,000, we haven't really given any bias to any particular area. But coincidentally, as you've said, we're seeing commonality where the Forex pairs tend to congregate somewhere between 200 and 500, I think, and the commodities got a different profile again, and then the equities tend to be even longer.
Yeah.
So it's yeah. So hopefully that might answer the question that was originally asked. I don't know if we want to talk too much further on this, but thanks for your time tonight, Rich.
Yeah, thanks, Fred. That's great, mate, and we'll try and make this a more regular occurrence.
Yeah, okay, mate. Talk to you soon.
See you. Bye.
Bye.